Now, obviously, the question could also be compute the tax base or around the tax base. Now, what is tax base? Basically, okay. Now, this is tax base. This refers to tax base. When I say tax base, basically I want to know what is the tax written down value, the amount, the tax base of assets means the amount that's deductible for tax purposes in the future years. Means the written down value as per the Income Tax Act is the tax base. That's all. The WDV using the tax rate, the WDV of the assets when you use the income tax rates is called as tax base. So if I take an asset worth 21 and I depreciate it as per Income Tax Act, I get 7,000. This is the tax base in year 1. Year 2, 21, I took further 46, it's a tax for year 2. And year 3 becomes 0. Now what is interesting is the accounting value. The accounting WDV in year 1, right? Accounting WDV will be how much? 14,000 because you depreciate only 7,000, then 7,000 and 0. This is accounting value, this is tax value.
How we get this 14,000, 18,000 and 21,000?
This is accumulated depreciation. So if you go to the earlier slide, look at this. Now, what's my depreciation every year? 14.
14.
What's my year to depreciation? 466. Cumulative is 18. This is accumulative.
Okay.
Cumulative. Got it? So if I was to take accumulated as per accounting, it will be 21 minus 17, 7. 21 minus 14. Year 2, no? Cumulative. And 21 minus 21, which is year 3. So I'm just cumulating every year depreciation. Year 1 is 14. Year 1 plus year 2 is 18. Year 1 plus year 2 plus year 3 is 21. Okay, this is a presentation disclosure requirement. Okay, now what this slide is trying to show is very interesting. That if I tell you that tax base is this and accounting base is this, that means what is the difference between these two values on account of? Answer. This and this. What's the difference in the two values? 7. What is it on account of? It's on account of what? It's on account of depreciation charged. Tax allowed 14, you took only 7. So the short charge of 7,000 is the difference. Tax allowed 18, you took 14, right? So the short charge of 4,667. Tax allowed 21, you took 21, there is no short charge here. So this difference is directly on account of the depreciation charge till date. So I could also take the tax base and the accounting base difference and get the value 7,000. That into 30% will give me 2,100. This is the closing DTL. So if I tell you find the closing DTL, you can find the closing tax base, the closing accounting base, and get the closing DTL. But this is only for closing DTL. Shortcut way. Got it? And the proof, I'll show you 2,100. Let's come here. What is tax base? 2,333. What is accounting base? 7,000. What is the difference? 4,667. What is the 30% coming to? 1,400. That means closing DTL has fallen to 1,400. And the proof is there here. Closing DTL has become 1,400. 20 minus 7. Got it? And 1,400 minus 14 became 0. And that is proof here that closing DTL is 0. So if I tell you to find, so make a note of this formula somewhere. Closing value of DTL or DTA is also equal to tax base minus accounting base. The difference in the two bases is on account of cumulative timing differences into tax percentage. This is my indirect shortcut of finding out closing DTA or DTL. DTA. Got it? This is cumulative till date. Got it? So this is often asked when they tell you the tax base is so much, but as per books your value is so much. Also closing DTA, DTL. Now you have to remember the logic I taught you yesterday. If the tax base is more, it's an asset. That means they give you less depreciation. Less depreciation means more income. More income means more tax. So it's a deferred tax asset because they have charged you more. But here you notice, right? Cumulatively, less depreciation will be more income. No, so less depreciation will be more income, and more tax have to pay to the tax people, right? In the future, right? So your more depreciation is less income, less tax, therefore deferred tax liabilities. If it was more depreciation, then less income, less tax, deferred tax asset, right? So the formula is if this is more than this, if this is more than this, then deferred tax asset. But if this is less than this, then deferred tax. Yeah, and that is a very important logic that you need to remember. Okay, and remember by the formula. Okay, it's more because of less depreciation. It's less because of more depreciation. Okay. Now this was completely the tax-based perspective.